In 2021, thousands of investors received a tax bill for a fund that LOST them money. This is a true story, and it might be happening to you right now. I need to tell you about something that happened to real investors in 2021. People who did everything right. They bought a diversified ETF. They held it for the year. They were patient, responsible investors. And then January came, and their accountant called them and told them they owed the IRS thousands of dollars peckers in capital gains taxes on a fund that had lost them money. They paid taxes on profits they never received from an investment that went down because of a rule buried in the fine print of their ETF that almost nobody understands. This is ETF mistake note 2. And unlike the overlap mistake from episode 1, this one doesn't just quietly drain your returns. This one sends you a bill, a real bill from the IRS at the exact moment you can least afford it. The tax trap, how ETFs can generate tax bills without generating profits. Welcome back. If you're new here, I break down the real mechanics of investing, the stuff the financial industry hopes you never figure out. In episode 1, we talked about ETF overlap, how owning 5 different ETFs can mean you're actually just holding the same 12 stocks over and over with different labels. If you missed it, go watch it first. Link is in the description. Today, we're going deeper and darker. Because today we're talking about capital gains distributions, CARDN, the hidden tax event inside certain ETFs that can trigger a tax bill even in a year when your investment lost money. This is one of the least understood and most financially damaging things in retail investing. And by the end of this video, you'll know exactly what it is, which ETFs are at risk, how to check your own portfolio, and how to protect yourself starting today. Let's go. Let me tell you exactly what happened in 2021. It was a brutal year and for a lot of actively managed mutual funds and certain ETFs. The market was volatile. Many funds were down. But behind the scenes, fund managers were doing something that would blindside their investors. When markets get choppy, fund managers sell holdings inside the fund. Boards to rebalance, to meet redemptions, to shift strategy, those internal sales, they can generate capital gains. And here's the rule that most investors have never heard of. When a fund realizes capital gains internally carried, it must distribute them to shareholders by year end. It doesn't matter if the fund lost money overall. It doesn't matter if YOU personally lost money. If the fund sold positions internally at a profit at any point during the year, you owe the IRS your share. In 2021, the American Funds Growth Fund of America distributed over $8 per share in capital gains. The Fidelity Contra Fund distributed over $10 per share. Some Vanguard actively managed funds distributed over 15% of their NAV in taxable gains. Investors who were sitting on losses still got tax bills, sometimes for thousands of dollars. This wasn't fraud. This wasn't illegal. It was the system working exactly as designed. A system designed with fund managers in mind, Kang, not you. Timeline showing, fund loses value, manager sells holdings internally, capital gains realized, distribution sent to YOU, tax bill arrives in January, your investment is still down. Okay, I want to make sure you understand the exact mechanism here, because once you see it, Rumfer, you can never unsee it. When you buy an ETF, you're buying a wrapper. Inside that wrapper are individual stocks or bonds. Now, playing with a traditional index ETF like VOO or VTI, the fund barely ever sells anything. It just holds the index. So it almost never generates internal capital gains. And this is one of the beautiful things about passive index investing. But here's where it gets dangerous. Certain types of funds, one, actively managed ETFs, older mutual fund style ETFs, and some thematic or sector funds, CREAM, they trade constantly inside the wrapper. The manager is buying this, selling that, rotating out of this sector, moving into that one, every time they sell a position that has a gain. Preach, even if the overall fund is downplunged, that gain gets crystallized. It becomes a realized capital gain. And at the end of the year, the IRS requires the fund to distribute those gains to shareholders. So even though you, sitting at home, never sold a single share, the fund sold on your behalf, generated gains on your behalf, and now you owe taxes on your behalf. This is the difference between a tax-efficient ETF and a tax-inefficient one. And most investors have never been told this distinction exists. Now, I want to show you the real cost of this. Not just the one-year tax bill for you, but the compounding damage over time. Let's say you have $100,000 in an actively managed ETF. The fund has a capital gains distribution rate of 5% per year. That's not unusual, Head. Some funds distribute 10%, 15%, even 20% in volatile years. 5% of $100,000 is $5,000 in distributed gains. If you're in the 22% tax bracket, that's $1,100 out of your pocket for gains you never personally received. Now, that $1,100 isn't just gone today. It's gone from your compounding base. Over 30 years at a 7% average annual return, that single $1,100 would have grown to over $8,000. Not $1,100, $8,000. Now multiply that by 30 years of annual distributions. We're talking about a six-figure tax drag over a lifetime of investing. Not because you made bad investments, not because you sold at the wrong time, because you own the wrong type of ETF. Most investors don't realize the silent killer of their returns is right here. Over 30 years, it cost this portfolio $235,000. Same investment, same market, same time horizon. The only difference was tax efficiency. Let's get specific, because not all ETFs are created equal when it comes to tax risk. Here's your quick guide to ETF tax danger levels. These track and index passively, barely any internal trading. Capital gains distributions are rare, sometimes zero for years at a time. Rates first. This is your safest zone. Yellow, moderate tax risk. Factor ETFs, smart beta dividend ETFs, SCHD. Some internal trading happens. Capital gains distributions occur, but are usually modest. Fine to own. Just watch the distribution history. High tax risk. Actively managed ETFs, ARKK, CGDV, JPST, many newer intelligent ETFs. Fund managers trade constantly inside the wrapper. High turnover equals high capital gains distribution risk. These can generate massive taxable events even in down years. Extreme risk, the granddaddy tax bombs. Mutual funds masquerading as ETFs, older share classes converted to ETFs, leveraged and inverse ETFs. These can distribute 20 to 30% of NAV in a single year. If you own these in a taxable account SPIRM, you need to check immediately. These risks only apply to taxable accounts in a 401k or IRA. Capital gains distribution, they're sheltered. Here's something that blew my mind when I first learned it, Twain, and it explains why index ETFs are so much better at avoiding this problem. It comes down to something called the creation and redemption mechanism, and it is genuinely one of the most elegant pieces of financial engineering ever invented. When a regular mutual fund has investor outflows, right? When people pull their money outflow, the fund has to sell holdings to raise cash. Those sales generate capital gains, which get distributed to everyone still in the fund, even you, just sitting there holding it. ETFs are different. When big institutional investors want to exit an ETF pinouts, they don't sell shares back to the fund for cash. Instead, they receive a basket of the actual underlying stocks, in kind. No cash changes hands inside the fund. And here's the magic. Because it's an in-kind transfer, which is not a cash sale in him, no capital gain is triggered inside the fund. The gain travels with the stock out the door. The remaining ETF shareholders, they never see a tax bill from it. This mechanism strat, this simple structural difference strat, is worth tens of thousands of dollars to a long-term investor. And it's the reason why if you're investing in a taxable account, the type of fund structure you choose matters as much as the expense ratio. But tell it, and this is important, Trim, not every ETF uses this mechanism fully. Actively managed ETFs, thematic ETFs, and ETFs with high turnover still generate internal taxable events because they're actively selling positions. The creation/redemption mechanism protects you from outflow-driven gains. It doesn't protect you from manager-driven gains. Two different problems, two different solutions. I want to step back from the mechanics for a second, because I know some of you are sitting there thinking, is this really that common? Is this really happening to regular people? Let me tell you about a specific situation that gets repeated thousands of times every January across America. A 34-year-old teacher in Ohio invests $800 a month into her brokerage account. She's responsible. She's doing everything she was told to do. She owns a mix of ETFs, some index funds, a couple of thematic ones her coworker recommended, an actively managed one she saw on a financial blog. 2022 was a brutal year. Her portfolio dropped. She lost paper value on almost everything. January 2023, she gets her 1099 DIV in the mail. Capital gains distributions, $4,200. She calls her accountant. What is this? I lost money this year. She owes taxes on $4,200 in gains she never saw from a fund she's still holding that's currently worth less than what she paid for. She has to liquidate some shares at a loss just to pay the tax bill. She sells low to pay taxes on highs she never received. That's not bad luck. That's not market risk. That's structural. That's the system. And it happens every single year.
to millions of people who have no idea it's coming. All right, let's fix this now. Here's exactly how to audit your own ETFs for tax risk in under 10 minutes. Free, no account needed. Step 1, go to ETF.com or Morningstar.com. Type in the ticker of each ETF you own. Step 2, look for 2 specific numbers: portfolio turnover rate. Capital gains distribution history portfolio turnover tells you how much the fund trades internally per year. A turnover rate under 10%, very tax efficient. That's your green zone. 10 to 50%, yellow, watch it. Over 50%, that fund is trading constantly, high tax risk. Step 3, check the distribution history tab. Look at the past 3-5 years. Has this fund ever distributed capital gains? How much? If you see consistent capital gains distributions, especially in years when the market was down, that's your red flag. Step 4, check your account type. Are you holding this ETF in a taxable brokerage account or in a 401k/IRA? If it's in a retirement account, capital gains distributions don't matter. You're sheltered. If it's in a taxable account, this matters enormously. If all 3, you're in the green zone. If any are NO in a taxable account, you have tax risk. Step 5, the placement strategy. This is where it gets powerful. Not all ETFs need to go in the same account. Tax-efficient ETFs like VTI, VOO, these are fine in your taxable brokerage. Tax-inefficient ETFs, actively managed high-turnover REITs, these belong in your IRA or 401k, where gains are sheltered. This is called asset location. And it is one of the most underused strategies in retail investing. Same assets, different accounts, dramatically different tax outcomes. Let me show you the actual dollar difference. Meet investor A and investor B. Same age, same salary, same monthly investment. Hey, $1,000 a month. They own the exact same ETFs. The only difference? Investor A puts everything in a taxable brokerage account. Index ETFs, actively managed ETFs, dividend ETFs, all mixed together. Investor B uses the tax stack. Tax-efficient ETFs and taxable, everything else in the IRA. $320,000. Not from picking better stocks, not from timing the market, just from putting the right ETF in the right account. That's the cost of not knowing. And nobody, not your brokerage, not the fund company, not the financial media, nobody is going to call you and explain this.
Now, for those of you who want to go one level deeper, and I want to talk about tax loss harvesting, because this is the offensive weapon that sophisticated investors use to actually turn the tax code in their favor. Here's the concept. You have an ETF that's currently down. Let's say you bought QQQ at $380 and it's now trading at $310. You're sitting on a $70 per share unrealized loss. Tax loss harvesting says, sell it. Realize that loss intentionally. Now you have a capital loss on the books. That loss can offset capital gains, including those forced capital gains distributions we just talked about. It can offset up to $3,000 per year of ordinary income, and any unused losses carry forward to future years indefinitely. But here's the part most people get wrong, and why a lot of DIY tax loss harvesting backfires. The wash sale rule. If you sell an ETF at a loss and buy it back, or buy a substantially identical security within 30 days before or after the sale, the IRS disallows your loss. You don't get the deduction. NOT a wash sale, loss preserved. This is why the ETF universe is actually perfect for tax loss harvesting, because there are so many similar but not identical funds you can swap into. Stay fully invested, maintain your market exposure, and still capture the tax loss. This is what the ultra wealthy do. With automated software called direct indexing that does this every single day, you can do a manual version of it yourself twice a year and get most of the benefit. You now know mistake no 1, overlap. You now know mistake no 2, the tax trap. But mistake no 3, is the one that ends careers. In episode 1, we talked about the overlap trap, how 5 ETFs can secretly be one. Today, we went deeper, the tax trap, how the wrong ETF in the wrong account can cost you hundreds of thousands of dollars in silent tax, drag over your investing lifetime. But mistake number 3, it's different, because the first 2 mistakes, you can fix them. Right now, move the accounts around, switch the funds, done. Mistake number 3 hits you at a specific moment in time, one window. And if you miss it, or you're in the wrong ETF when it happens, the damage can be permanent. I'm talking about sequence of returns risk, ma'am, and the specific ETF structures that make it catastrophically worse. This is the mistake I see destroying retirement accounts for people in their late 50s who have done everything else right for 30 years. One wrong ETF choice at the wrong moment, and 30 years of work gets cut in half. That video drops next week. Subscribe, hit the bell, do not miss it.